bank regulators have seized Silicon Valley Bank in the largest bank failure since the Great Recession.
Customers were rushing to take their money out.
Get the money out.
There are recent developments that concern a few banks.
In only a matter of 48 hours, the 16th largest bank in the United States goes from stable ground to underwater. Silicon Valley Bank, known as SVB, was a go-to in the tech world. A bank with around 40 years of experience, and where half of the venture-backed startups got their money in the United States. Silicon Valley Bank saw a sudden and abrupt downfall, which trapped billions in investments and deposits. Its capital shrank and caused the beginning of one of the greatest bank runs in the history of the United States. So, how did the most respected bank in Silicon Valley collapse like that? What happened to the Silicon Valley Bank and caused the second most significant crash in US banking history since the 2008 crisis? In this video, we are going to unfold the bitter truth. Imagine a situation when all the customers start to withdraw all their money from the bank, and that too all at once. The bank would face a liquidity crisis. To fund the requisite cash flow, what should the bank do? It has to start selling off its assets at whatever price is obtainable in the market to get the cash. And as simple as that, the swift downfall started for the Silicon Valley Bank. Once popular among venture capitalists and startups, known for their services for top tech companies like Shopify and Pinterest, had to shut their doors to their customers. Let us get into a deep analysis of the downfall of the Silicon Valley Bank. To understand the cause of the problem, we need to analyze the environment that gave birth to the problem. Let's dive into the past. When the pandemic started at the beginning of 2020, Silicon Valley Bank had $60 billion in deposits, and things were looking really bright. Money was flowing big in Silicon Valley, and the startups had lots of cash supply, and most of it was kept in the Silicon Valley Bank. By the beginning of 2022, SVP had deposits of around $200 billion, more than 3 times what the bank had in 2020. At that time, there was so much money in Silicon Valley that nobody wanted a loan. As they had a lot of funds and no one to lend it out to, but still wanted to generate a profit, what did the bank do? They went out and found the safest option available. They invest in long-term US treasuries and government-backed mortgage securities, the safest thing you can buy with a guaranteed return. From the beginning of 2020 till the end of 2021, their investment portfolio in these types of securities grew from $27 billion to $128 billion. It was all good until the interest rate started going up in 2022. To understand this, you need to know, in general, bonds have an inverse relationship with interest rates. That means that when rates rise, bond prices fall. So when the Federal Reserve started to hike rates rapidly to combat inflation, SVB's bond portfolio started to lose significant value. If SVB were able to hold these bonds until they matured, then they would receive their capital back. However, as the economic conditions worsened over the last year, with tech companies particularly affected, many of the bank's customers started to withdraw their deposits. And to fund these cash outflows, Silicon Valley Bank had to start selling off its securities, with significant price cuts. Shortly after, on March 8th, Silicon Valley Bank sent a press release that they've sold a large chunk of these securities, and they've lost $1.5 billion in the process. People started panicking, and they started talking. When the stock markets opened on Thursday, the 9th of March 2023, things started to fall apart. SVB stock was in freefall. They were down by a margin of 60%, and more panic spread. More customers started withdrawing their money. On this Thursday alone, $42 billion were withdrawn from the Silicon Valley Bank. Can you imagine that amount, just in one day? On the upcoming Friday, the 10th of March in the morning, people stood in huge lines in front of several branches of the Silicon Valley Bank, only to find the bank has closed and will not open. It only took 48 hours to erase a 40-year-old bank. So, what did this mean for customers? FDIC, the Federal Deposit Insurance Corporation, has taken control of the Silicon Valley Bank. Any balances under $250,000 are fully insured and will be available by Monday, the 13th of March 2023. But if the balance is over $250,000, the customer will get a receivership certificate, as well as an advance dividend within a week or so. This advance dividend could be the whole amount or a portion of the whole, but the main issue is time. To receive any amount over $250,000, the customers will have to wait till the bank sells some of its assets to generate cash. This has had a huge impact on startups who have millions of dollars deposited with Silicon Valley Bank. Even though there is no question that the depositors will surely receive all of their money back, the length of time that will take to happen will be a big concern for companies. Though the long-term problem could be resolved, the short-term cash crisis is going to have a humongous impact on the operations of many startups. What is the implication for other banks? The Silicon Valley Bank's sudden collapse hit customers hard, prompting many to rush to First Republic banks for withdrawals. Numerous First Republic Bank branches had lines of people seeking to safeguard their investments as fears about the health of the Silicon Valley-based bank began to rise. The bank tried to calm any worries as its stock plunged, saying its deposit base is strong and very well diversified, and its investment portfolio is stable. The ripple effects of Silicon Valley Bank's failure also hit companies and small businesses. But what about large banks such as Chase or Bank of America? Are they feeling the impact of failure from SVB? The answer is probably no. However, one can seldom know what may happen in the future. The large banks have diverse portfolios, unlike Silicon Valley Bank, which only invested in long-term U.S. Treasury and similar securities. As large banks have various portfolios, a loss in one sector is often offset by a gain in another. What can investors learn from this incident? The major mistake the tech companies made was that they invested all their money just in the Silicon Valley Bank. They did not diversify their cash. So when the economic condition degraded and the companies were in need of cash, they started withdrawing heavily. And this led to the SVB falling into a serious liquidity crisis and eventually collapsing. You probably have heard the famous saying, "Don't put all your eggs in one basket." When you have excess cash in hand, you would generally go to the bank to deposit your money. When the amount is insignificant, it is not much of an issue if you bank with only one bank. But if you have cash worth over the insured limit of $250,000, you should seriously consider having multiple bank accounts with different banks, and also invest in different facilities and investments. And with this said, we made it our personal goal to bring financial education to people easily and efficiently. This way, each of you gets the right tools and wisdom to achieve your personal financial freedom. Dear 101 community, sometimes it's as simple as that. Thanks for watching, and don't forget to hit the like button and subscribe for more financial education content. Also, do not forget to check out the links in the video description. We also have a free guide to your financial education in the video description. Watch our video appearing on the screen. We are sure this will also help you on your path to financial education.